Hi, I'm Jimmy. In this video, we're looking at Raytheon Technologies, ticker symbol RTX. So we're going to look quickly at the basics of Raytheon's business, and then we're going to dive into what their business looks like since they merged Raytheon and United Technologies to form Raytheon Technologies. And then we'll try to come up with a fair value for Raytheon Technologies stock. Okay, so let's start with the recent merger between Raytheon and United Technologies. So, independently, both Raytheon and United Technologies had rather similar businesses. United Technologies broke their business into four main segments. They had Collins Aerospace, which is an aerospace and defense company. Then they had Pratt & Whitney, which manufactures and services aircraft engines and auxiliary power units. Next, they had Carrier Worldwide, and then they do heating and air conditioning. And then finally, they had Otis, which was an elevator and escalator company. Now, we may know that during this merger, both Otis and Carrier got spun off into their own public companies. Otis trades under the ticker OTIS, and Carrier trades under the ticker CARR. And they both look somewhat interesting at first glance, although I haven't done a deeper dive on either company just yet. Okay, then with both their Pratt & Whitney and then their Collins Aerospace business, they're staying in the new merged Raytheon Technologies. Okay, simple enough. Now let's jump over to Raytheon's business. So Raytheon, before the merger, well, they also had four different segments. They had missile systems, integrated defense systems, they had space and airborne, and then finally they had intelligence, information, and services. Their missile systems was the largest of the four segments, but not by much. This was a fairly well-rounded company before the merger. Okay, now going forward, as part of the new Raytheon Technologies, they've merged missile systems and integrated defense systems to form missiles and defense. Then the other two segments also merged. They're forming a new segment that they're calling intelligence and space. So this is what we end up from the old Raytheon business. And then we add back both Pratt & Whitney and Collins Aerospace. Well, this is what the four new segments are most likely to look like for the new Raytheon's Technologies business. Okay, now this brings us to the issues that the business is running into right now. Clearly, at first glance, we could guess that given the current state of travel, and when we consider businesses like any one of the airline companies or companies like Boeing or Airbus, well, clearly we know there's been a lot of trouble there, so we can expect for some of their commercial airline businesses to struggle in the next, let's say, at least year or two. Now, at some point, I would expect for that to change, but for now, we can assume that some of their business lines, specifically Collins, and anything that they have tied to the commercial airline business, well, that's going to get hurt a decent amount. But they also have a large portion of their businesses tied to defense contracts. In fact, from the most recent numbers that I could find, it showed that the US government was their biggest customer, and I think it accounted for about 16% of revenue. Now, their next largest customer was Airbus, and then finally was Boeing. So I think it's probably safe to assume that the revenue from the US government is going to be perfectly fine. This is likely to be the dominant driver of profits or free cash flow, while Airbus and Boeing are likely to drag them down for at least the next year or two. Okay, so with those assumptions, now let's jump over to the valuation of Raytheon Technologies stock. Now, I actually wanted to try two different valuation methods for valuing Raytheon stock, partially because I think it's a bit tricky. If we look at our free cash flow valuation, I'm a bit less confident with projecting free cash flow in more than a year or two. So with this valuation, that would mean that 2022 and 2023 numbers, I'm a bit less confident about. I just took some of these estimates from analyst reports that I was able to find. Now, if you're curious how to do this whole calculation, I actually did a whole video on how to do this entire thing. I have an Excel template and all of that. If you're curious, I'll leave a link in the description below to that video. But what I did is I took our expected free cash flow and discounted that by a required rate of return of 7.5%. Then we grew it out by a perpetual growth rate of 2.5%. That gives us our total company value. We take that, divide that by the shares outstanding. That gives us a fair value of the company of about $94 per share. Now, Raytheon has a bit of debt, so we're going to want to adjust this valuation to account for net debt. Net debt is simply their debt, the debt that they have offset by any cash that they have. This is what that adjustment looks like. Now we take the new net debt adjustment, that's a new company value, we divide that by the shares outstanding, and now we have a fair value of about $78 per share. Okay, so $78 per share looks decent given that their stock is currently trading right around the $60 per share range. But now let's try a different valuation method. So here we're going to use a free cash flow yield to try to come up with the fair value for Raytheon stock. Okay, so here's what free cash flow yield is, or really how to calculate any yield. Let's take a popular yield that many of us know, which is the dividend yield. So with dividend yield, we simply take the dividend per share. Let's imagine that our hypothetical company has a $5 dividend each year. Well, we take that, we divide it by the current price. Let's imagine that this stock is trading at $100 per share. Well, 5 divided by 100, well, we know that this has a dividend yield of 5%. If they had a $50 price, it would be 5 divided by 50, a 10% dividend yield. We could do the same things with earnings per share. Let's imagine that the same company had $10 in earnings per share. Well, same math remains. If the stock is trading at 100, 10 divided by 100, and we end up with an earnings yield of 10%. We may notice that this math is very similar to price to earnings ratio. We're just taking the inverse of it. So if we take the price, $100, and we divide that by $10 in earnings per share, well, that is the same as 10x for price to earnings ratio. Okay, but now if we switch back to our discounted cash flow numbers real quick, let's take our 2021 free cash flow estimates. So we take that 7542, which is the same as 7.54 billion, and we divide that by their expected shares outstanding. Right now, they have shares outstanding of about 1.52 billion shares. But both Raytheon and United Technologies bought back shares fairly consistently before the merger. So there's no reason for us to expect for that not to continue. Now, I'm not sure that they're going to do any buybacks in 2020, given everything that's happening right now with the coronavirus and pretty much everything. But personally, I would expect that they would start doing it again in 2021. So I estimated that they would do some buybacks in 2021, and I put their shares at 1501, which is 1.5 billion, basically, 01. So we take our 2021 estimates for free cash flow, we divide those by the shares outstanding, or our expected shares outstanding, and we end up with an estimated free cash flow per share of about $5.02. Okay, now this is where it gets interesting. Now we have to make an assumption about what their free cash flow yield should be, or what it will be. So what I did is I calculated their free cash flow yield for both companies going back to 2006. And I went back to 2006 because I wanted to make sure I included the financial crisis. I also only went up to 2018 because I thought it made sense to stop before the merger came into play. Then I averaged out both Raytheon's and United Technologies' free cash flow yield, and I rounded those numbers to be a combined about 6.5%. So what if we were to assume that the free cash flow yield is going to be 6.5% in 2021? Well, that would give us a fair value of the stock in 2021 of about $77 per share. Now, if you're curious how to do that, you take the $5.02, divide that by 0.065, which represents the 6.5% free cash flow yield, you end up with about $77. But that's in 2021. Now, what we need to do is we need to discount that by 1 year to bring it into 2020. So I'm assuming that we're using the same required rate of return of 7.5% that we used in our discounted cash flow calculation. That brings a fair value to about $72 per share. Now, if we're curious, we discount that number. We take the 77, divide it by 1 plus our discount rate. So 77 divided by 1.075, that gives us 72. Okay, so using our free cash flow yield, we got a fair value for Raytheon stock of about $72 per share. Using our DCF, we got a fair value of about $78 per share. So let's just ballpark this and say that a rough estimate of Raytheon's fair value would be about $75 per share. Once again, the stock's trading at about $60 per share. So at $60 per share, if we think the stock could go to $75, well, that's almost 25% upside. And frankly, that looks quite appealing to me. Now, I personally don't own any shares of Raytheon, but I might pick up some soon because this came out much better than I expected. Now, I actually found this analysis to be quite an interesting one because I had to dig through a lot of different financials to sort it all out. Don't forget, they spun off Otis and Carrier, so that had to be accounted for in the free cash flow. And I tried to account for that as we were making estimates going forward. But luckily, they recently reported quarterly earnings, so we had an idea of how they would account for some things going forward. Now, there are still some questions as to how they're going to situate things going forward, but that's why I opted to use 2021 free cash flow estimates and not 2020. I think there's too many questions since the merger just happened. So we use 2021, keep it a bit more simple, and then just discount it back to today. Now, if you'd like to try to apply the same process that I used in trying to come up with this analysis, I actually did a video where I go through, I call it 8 simple steps to analyze a stock. And that's the exact process I used for this analysis. So if you're curious, there's a link right here and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I hope you found this interesting. Thanks, and I'll see you in the next video.